Look around the room. The phone, the car outside, the furniture, maybe the home itself. Most people call these things assets, things they own, things with value. And most people are wrong about almost every single one of them. There is a one-question test that separates the two categories, and it is the most important question in personal finance. Does this thing put money into the pocket or take money out of it? That is the entire test. Not what something cost, not what it could sell for, not whether it looks like wealth. Just the direction the money flows every month. Things that put money in are assets. Things that take money out are liabilities. And the uncomfortable truth is that most of what people own, including the things they are proudest of, sits firmly in the second category. Start with the biggest example, because it is sitting in almost every driveway. The average new vehicle in 2026 costs nearly $50,000, with an average payment around $749 a month. That payment is only the visible part. According to AAA data, the average total ownership cost for a new vehicle is $11,577 annually, roughly $965 per month, covering depreciation, financing, fuel, insurance, maintenance, and registration. And the largest piece of that cost is the one nobody sees leaving. Depreciation is the single biggest expense, with vehicles losing an average of $4,334 in value per year. New cars typically lose 15% to 20% of their value in the first year alone, and by the end of year 3, a new car may have shed 40% or more of its original price. Run the one-question test. Does the car put money in or take money out? It takes out the payment, the insurance, the fuel, the maintenance, and on top of all of it, the thing itself is dissolving in value the entire time. The car is not an asset. It is one of the most expensive liabilities most people will ever own. A machine that consumes nearly $1,000 a month while destroying its own resale value. This does not mean nobody should own a car. It means calling it an asset is an accounting error, one that hides its true cost and makes people feel wealthier than they are. Now, the harder one, the home. The family home passes the ownership test and fails the cash flow test. Every month it takes out the mortgage payment, the property tax, the insurance, the repairs, the utilities. It puts nothing in. By the one-question test, a primary residence is a liability, an often worthwhile one, sometimes an appreciating one, but a liability in cash flow terms all the same. The identical house one street over, rented out to a tenant whose payment covers the mortgage and leaves a surplus, that house is an asset. Same walls, same roof. The difference is not the property, it is the direction the money flows. This is the distinction that separates the balance sheet of someone building wealth from someone who merely owns expensive things. The asset column is not about what things are, it is about what they do. Index funds and stocks, ownership in companies that generate profits, pay dividends, and grow in value. Money in a high-yield account earning real interest. A rental property with positive cash flow. A business, even a small one, that earns more than it costs to run. Skills that measurably increase income. Content, products, or systems built once that keep paying. Everything covered in the passive income video. The common thread. Each one either sends cash in every month or grows in value while costing nothing to hold. The pattern behind wealth, and the pattern behind staying broke, comes down to a loop. People who stay broke run this loop. Income arrives, and it goes toward liabilities that look like assets. The newer car, the bigger TV, the upgraded phone. Each purchase adds a monthly outflow. The outflows accumulate until the entire paycheck is spoken for before it arrives. More income triggers more liabilities, the lifestyle inflation from previous videos, and the loop tightens with every raise. People who build wealth run the opposite loop. Income arrives, and a portion buys assets first. The assets generate their own small income. That income buys more assets. Slowly, the asset column starts producing enough to cover expenses, first a phone bill, then a car payment, eventually a lifestyle. Every luxury they buy later is purchased not by their labor, but by their asset column. The wealthy buy their comforts with money their money made. The difference between the two loops in year 1 is almost invisible. The difference in year 10 is a completely different life. And the entry point is the same one-question test applied to the very next purchase. Does this put money in or take money out? 3 honest clarifications, because the test is simple, but life is not. First, liabilities are not sins. A car that gets someone to a job is a liability that enables income. A home provides stability no spreadsheet captures. The goal is not to own 0 liabilities. The goal is to know which is which, and to stop letting liabilities wear asset costumes. Second, the trap is not buying liabilities, it is buying them before assets. The person who buys the $50,000 car first has locked $965 a month into an outflow for years. The person who builds the asset column first and lets it grow eventually buys the same car. Except by then, dividends and gains are covering part of the payment. Same purchase, opposite financial consequence. Sequence is everything. The same lesson from the money sequence video, operating at the level of an entire life. Third, the fastest upgrade available is converting dead money into assets. Money idling in a 0.45% account converts to a high-yield account in 15 minutes. The overpriced depreciating car converts into a 3 to 5-year-old used one, which has already absorbed the steepest depreciation, freeing hundreds monthly for the asset column. No extra income required, just reassigning what already exists from the taking out column to the putting in column. Every video on this channel has secretly been about this one test. The savings account trap, dead money failing the test. The bank video, becoming the asset owner instead of the fee payer. The tax video, the entire system rewarding the asset column. The freedom number, the exact size the asset column needs to reach before work becomes optional. Rich people do not own more expensive things, they own more things that pay them. That is the entire difference, and it starts with a single question asked before the next purchase. Drop a comment with one thing owned that passes the test, and one thing that fails it. The next video covers the first assets worth buying at every budget level, starting from under $100.